Functional standard risks are those that affect a majority of companies regardless of their industry, size, and depth of operations. All companies can encounter on a regular basis finance and funding risks, cash flow risks, insurance risks, safety and accident risks, labor and staffing risks, materials and equipment risks, and last but not least, sales and marketing risks. So starting with financing and funding risks, very few companies never have a need to do without some type of financing and/or funding of a project or operation. Investments into your company or loans from financial institutions are a normal or standard part of your financial function. Whether you seek funding to buy a car, truck, piece of equipment, build a new facility, few companies will pay for these items in cash. As a consequence, you finance them through standard avenues such as banks. The key here is, can you handle the debt payments? Do you have too much debt? Are you using too much cash in the process, leaving less for expansion? That's where cash flow, as a part of this method, comes into play. Is your cash flow sufficient to pay for debt, payroll, bills, and other typical expenses? Are you as a company reliant on a small number of customers for your cash flow? Or do you have a diverse customer base? If a major customer goes out of business or moves to your competition, will this impact your cash flow? If so, by how much? Insurance costs, especially with the typical loss-sensitive programs, can be very expensive. This is a standard cost of doing business. Have your insurance premiums risen at your last renewal? How does this increase affect your cash flow? Do you reduce your limits to pay less? Do you increase your deductibles? Safety and the frequency and severity of accidents have a direct impact on your insurance costs. Have your claims caused your premiums to go up? Have the injuries incurred caused loss of productivity? Have your property and equipment damages increased your costs of rentals? Have you been kicked off of job sites because of safety violations, losing that work? Is your staffing and labor pool causing problems because of their skills, or rather lack of skills? Are trades needed in demand, raising your costs to attract qualified employees? Have your employees poorly represented your company with your clients? When acquiring materials as part of your operations and developing your equipment resources, have you experienced shortages because of supply chain events, aging equipment requiring more repairs, rental costs because of specialized equipment not available internally? Have your sales kept up with the turnover of products, or are you incurring costs for increasing inventory? Has your marketing program been effective in increasing sales? If not, are you losing money because of excessive advertising costs? These and many other questions are the standard part of functional risks and should be in the first and main focus of attention in the risk identification process. Unique functional risks are, as the name implies, exceptional situations that may not directly apply to every business, industry, or sector. However, although this type of risk identification does not have many direct impacts, they can still have indirect implications. In other words, you may not experience a loss to your company as a direct result of an event, but the ripple effect of an event eventually reaching your company is certain. An example would be a company that's not in the oil and gas industry. A decrease in the price of oil can cause oil and gas companies to lay off staff, reduce operations, and shut down wells, showing the direct impact. But your company indirectly could benefit and realize losses as a result. The positive is lower gas prices. The negative, that this could impact one of your customers who in turn services the oil and gas industry. The ripple effects of seemingly unrelated events can be far-reaching. So as a functional unique risk, identifying ripple effects from geopolitical hotspots of wars, riots, civil unrest, hazardous environments and materials relating to job sites and locations or proximity threats, hazardous job classifications, for example, commercial divers, nuclear power plant workers, specialized skill sets in the human resource arena and their scarcity, special equipment and the materials with their price tag and availability. Special insurance coverage outside the ordinary that are also potentially expensive and difficult to acquire, and niche markets that can impact a company's revenue if a downturn occurs. All of these are unique in that not every company will experience these risks directly on a regular basis, but may on a periodic basis. Some may be impacted indirectly through a ripple effect. Some may never be affected. This method is the second classification of the risk identification process in order to better prioritize your respective risks. Projects' lifecycle risks are a functional risk that serious consideration is warranted and advised. From a timeline viewpoint, the planning process must be paramount to limit and avoid grave misjudgments leading to costly errors. Each phase and juncture of a project's lifecycle can create multiple risks that, if not identified in the planning process and assessed properly, will cause delays from a nuisance level to the point of shutting a job down. In the bid and estimating phase, pricing must take into consideration potentials that at various points in time require a contingency mindset, and part of the costing to build in these factors. As discussed previously, in an outdoor construction project, if you don't account for rain delays, then your timeline can be considerably longer than anticipated. Contractual obligations and commitments can also result in compliance risks in addition to delays, extra costs, up to and including the possibility of cessation of work and awarding to another contractor, or worse, penalties. Regardless, this phase of a project is the most critical part when identifying risks and aids in limiting risks and increasing profitability. Although each of the following appear to be distinct and separate aspects and phases, each must be incorporated in the bid and estimating process in addition to ongoing throughout a project. Resources, as discussed previously, include financial resources, human resources, asset resources, as in equipment and machinery. Each part of the phase comprises internal versus external staffing, equipment, and machinery. Obviously, if there are multiple projects running simultaneously, then all aspects of resources may be stretched, and contingencies must be a part of the process. Planning is one of those areas that is continuous from the bidding and estimating phase throughout a project. Planning should encompass monitoring on almost a daily basis, reviewing progress, making adjustments as needed, and proceeding with those changes. Any variance in the plan must be assessed for inherent risks and new, unanticipated risks that will invariably come up. Financial planning is another aspect that the accountants must review continuously in order to determine any budget variances, cost overruns, adjustments, and the possibility that additional capital may be needed to complete the project. While the risk management plan should include all aspects, typically this function will work with the insurance program and monitor claims and assess risks associated with trends and loss patterns. This function should also include the safety function to better control losses through a flexible approach depending on the accidents and incidents that are seen specific to this project. Although equipment and machinery planning was cited previously in this cycle, equipment and materials acquisition must be monitored to determine if the planning process was overly optimistic or pessimistic and make adjustments accordingly. Once all of the variables have been factored into the planning process, the implementation can begin with their onset of risks that may have been anticipated and planned for, but not necessarily in a certain sequence or degree. Flexibility is key. After a project has been completed, a debriefing process must be incorporated into this to develop lessons learned. That is to say, what went right, what went wrong, and how do we adjust our business mode for the next project to learn from these lessons? An old saying is that if we don't learn from our mistakes, we are doomed to repeat them.